Hey everybody, and welcome back. So in today's video, we're going to be talking about an IUL, otherwise known as an Indexed Universal Life Insurance Policy. These policies are going to work alongside well-known indexes such as the S&P 500. Because they're tied to an index, these policies are typically a little bit more risky and a lot more complex. These types of policies often work with a floor and a cap. So let's say, for example, John has an IUL and he has his policy set up to where he has a cap of 10% but a floor of 0%. Now, let's say hypothetically the account that it's tied to is performing, say, at 15% this year. Well, because John has a cap of 10%, his policy is only going to perform at 10% with that cap. But let's just say hypothetically, next year, that index that it's tied to is now performing at negative 5%. Well, John has a floor set at 0%. So because he has that floor set at 0%, he's not going to lose anything. This is going to allow John to have the benefits of working with an index as far as the high returns go, but not have the downside in case things aren't going very well. These types of plans can't lose money, which is why it's very appealing to some investors. In general, these types of policies are best for people with a large lump sum investment who are seeking a tax-free retirement. While the sales pitch on this product certainly sounds compelling on the surface, agents and advisors that are working with consumers should be warning them that the returns in these policies are far from guaranteed, and the cost of insurance down the road could become very expensive for you to keep this policy enforced. These types of policies will take the cost of insurance from the cash value if the policy premium is missed for whatever reason, or the premium is just not enough to cover the cost of insurance. If the policy cash value slips below zero, or there's just not enough funds in there to pay the cost of insurance, then the policy is going to lapse and you're going to be in a position where you have to pay very high premiums to keep that policy enforced. This could be putting you in a position where now you're 20 years older and your health just isn't the same, you're a lot older, and the price to have the insurance could be way more than what you can afford. Some pros for this type of policy is obviously higher return potential, the flexibility with your death benefit, the option to add riders onto the policy to make it a little bit more flexible for you, and then tax-free capital gains. Some of the cons on this type of a policy is obviously the cap on the returns. You can't go over a certain amount. There's no guarantees. There is a possible chance that the policy can lapse in the future when you need it most. And there's a lot of high fees. Now, if you happen to be on my website, you're going to notice that there are two different types of IULs that I provide. There's the accumulation IUL and then the protection IUL. The accumulation IUL is the highest cash value policy that we have. It's going to grow based on the performance of the S&P 500. You're going to select how much money you want to put into that policy every month and how long you want to make those payments for. Most people are going to do very large amounts every single month. You're typically going to start receiving a tax-free income, usually around the age 65, and it will go to the age 90, and this is going to be deducting from your death benefit. Protection IUL is a death benefit focused policy that also works alongside the S&P 500. You're going to select what you want that death benefit to be, how frequently you'd like to pay, and how long you'd like to pay. So are you thinking that an IUL makes sense for you? If so, reach out to me today. I'm more than happy to dive into a little bit more detail with you and answer any other questions that you might have. Thanks for watching, and come back soon.